Here's today's market movers with easy-to-follow futures and options trades.
Welcome to Market Movers. I'm Iuorio, and we are a week away from a Fed meeting that the market says will almost certainly result in a tightening to the tune of about 98% priced in. We're looking at using 10-year ZN weekly options to hedge or create additional exposure. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, so they're going to move. I'm not even going to ask you if they're going to tighten or not, because they are.
Come on,
right?
I wanted the layup question.
No, of course they're going to tighten. Are they tightening because they feel it's the appropriate maneuver at this point in time, or are they tightening because they said they would and the market believes they would?
I think it's because they watched the show, Market Movers. To be honest, because it's something we actually pointed out that I want to give you some credit for some months ago, which was talking about how transparent the Fed had become, and the fact that it's the end of Janet Yellen's reign here. So the reality is this. I think the fact that they've already transmitted this in the sense of already moving the markets, it would be a mistake to go back on it.
Okay, now, that being said, does the data warrant it, and how many hikes in 18?
It's funny about the data warranting it. Now, my point all along has been the data is good enough to allow it. And I know that's kind of a sheepish way to say it, but the problem with it is the data is not overheating to the tune where you say, okay, we've got to have 3 or 4 more hikes behind this, but the fact that you can get one in on the data that we have so far with 3% GDP, a couple of thousand average jobs created per month is a reason that you can have one more rate hike.
Because I agree with you. I think the data does warrant it, but the question to me always becomes, how high can they go with all these pension funds that are reliant on low rates, these companies that are reliant on low rates? We'll see. I'm not sure where this is going to end and how much rain they have. Now, before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary. We're pricing this up. The 10-year March contract now is trading 124.19 as we did this. Scott.
So looking at the fixed income complex across the board has been really interesting the last few weeks, really, as we've gotten into this Fed meeting. And I think it's really interesting to look at kind of how interest rates have reacted on the short end to the long end. So having the ZN here, I think, is really sensible when it comes to putting on some expression today. So specifically, Jim, I'm looking at buying the week 3 D's 124.123.5 put spread for 5 ticks. Expires December 15th. It's got the underlying, as you mentioned, at 124.19. It risks 78 to make a potential 422. Now, why am I putting on those levels? If you look at the recent moves in ZN, it's got kind of that little floor in the 124 area. But as we've seen these floors over the last few weeks get continuously broken, I feel like that's an area where you can put a little bit of, say, expression on to where I think we're going to see lower prices there, and therefore it's going to fill that put spread out very nicely.
I agree with you. I think rates are going up. I think they're going up not because the Fed is going to tighten. I think we're in this risk-on environment where stocks are rallying, Da Vinci paintings are rallying, Bitcoin's rallying.
Nice.
And it's a risk thing, and in a risk thing, you don't want to have long-end treasuries. And this is funny because my trade's very similar to you. I'm looking at buying the week 3 D's 124.25, 123.75, so it's a quarter tick higher. So we call it the quarter and 3/4, but those prices are 124.08 and 123.24. And that put spread you can buy for 8 ticks. It also expires December 15th. Underlying is 124.19, we said. This one risks 125 to make potential 375. The only difference between yours and mine is mine's a little more likely to happen, so you pay a higher price to get in. Thoughts?
Right.
You can't disagree with it that much. Yours is
I
very
love it.
similar.
I love it. I mean, I think you're on the right side for once, Jim. Welcome. But here's the thing. And when I look at the charts, like I mentioned, and then look at how the ZN's traded, it kind of is doing that stair step down. So I felt comfortable, like you said, for a little less cost, putting in that lower put spread strike because of the fact that I think we're going to continue to see those lower levels broken as rates rise.
Okay, now the question you avoided so deftly earlier, does the Fed hike twice, 3 times, 4 times in 18? Go.
You remember that Dodge move, that dodgeball move, which I was a champion of back in high school. I think there's 3 coming for sure. And Jerome Powell has laid that out to where I believe he's already laid the rug out to say, listen, I'm going to be accommodative. We're not going to step anything really big right away. But 3 rate hikes to me looks like a real possibility in 18.
I lean toward 2, but I don't disagree vehemently. I mean, 3 seems fine. Thank you for joining us on Market Movers. I'm Iuorio, where we're helping to make you a better trader.